Chasers, and welcome back to the Chasers channel, where we help business owners, professionals and families cut through the noise and make confident financial decisions. Now, today's episode is all about superannuation, and yes, I know super tax changes don't usually make for thrilling dinner table conversation, but this one actually matters, because from the 1st of July 2026, the rules around how super is taxed are changing. And whether you've got a modest balance or you're building something substantial, there are implications worth understanding. I'm Chris Becks, your host, a business and financial advisor with over 40 years experience and the founder of the multi-award-winning CBEX Business Solutions for Good. And because this is a financial planning topic, as an authorised representative of Interprac Financial Limited, I'm obliged to give you this general advice disclaimer before we begin.
The information provided is for educational purposes and is general advice only, as we did not take into account your investment objectives, financial situation or particular needs. Before making an investment decision on the basis of this advice, you should consider how appropriate the advice is to your particular investment needs and objectives. You should also consider the relevant product disclosure statement before making any decision relating to a financial product. Chris Becks is a director of CBEX Financial Solutions and an authorised representative of Interprac Financial Planning Proprietary Limited, AFSL 246638.
Okay, now that is done, let's dive into this episode. The government has announced a super tax shake-up aimed at making the system fairer and more sustainable long term. According to Treasurer Jim Chalmers, the changes reflect feedback from industry experts, financial advisors and everyday Australians. In a nutshell, the reforms focus on four key areas. Number one, more targeted tax rules for very large super balances. Number two, extra support for low income earners. Number three, indexation, so thresholds rise with inflation. Number four, and importantly, no tax on unrealised gains. That last point alone has eased a lot of concern. Let's tackle the headline grabber first. If your total super balance exceeds $3 million, you'll face a higher tax rate on some of your earnings. Here's how it works. Between $3 million to $10 million, earnings on this portion are taxed at 30% instead of the usual 15%. Anything over $10 million, the earnings above this level will be taxed at 40%. Now, context matters here. There are still concessional rates and they only apply to the portion of earnings above each threshold, not your entire balance. And importantly, thresholds will be indexed. The government has confirmed that the $3 million threshold will rise in $150,000 increments. The $10 million threshold will rise by $500,000 increments. This means fewer people will be affected over time as inflation pushes balances higher. In fact, fewer than 0.5% of Australians are expected to exceed $3 million in super by 26-27, and the $10 million rule impacts less than 0.1% of accounts. If you are affected, you also have flexibility. You can pay the additional tax from your super account or from personal funds outside super. One of the most controversial parts of the original proposal was the idea of taxing unrealised gains, meaning increases in asset values that haven't actually been sold. Think property inside super, or shares that have gone up on paper but haven't been cashed in. This is good news that the proposal has been scrapped. New rules also apply only to realised earnings, things like interest, dividends, rent or profits from selling assets. That's a significant relief for many superannuation fund trustees, particularly SMSFs, and long-term investors. Now, these changes aren't just about higher balances. There's also a meaningful boost for low-income Australians through the Low Income Superannuation Tax Offset, or LISTO. Currently, LISTO applies to people earning up to $37,000. The government refunds up to $500 of superannuation contributions tax. From the 1st of July 2027, the income threshold rises to $45,000. The maximum top-up increases to $810, reflecting the superannuation guarantee rate of 12%. This change will benefit around 3.1 million Australians, helping ensure low-income earners aren't penalised for saving for retirement. Now, some Australians, including judges and politicians, are members of defined benefit funds which work very differently to regular super accounts. Because earnings aren't as easy to calculate, the government has committed to developing equivalent arrangements to apply the new tax fairly. Details are still being worked out though, but the intention is consistency, not disadvantage. What you should do now. Here's the key takeaway. These changes don't start until the 1st of July 2026. They're based on your total super balance at the 30th of June 2027. And for most Australians, the impact will be minimal or even positive. But for business owners, professionals, SMSF trustees and families building long-term wealth, this is a planning conversation, not a panic moment. Now is the time to review your super strategy, understand your projected balance, and consider contribution timing, structures, and long-term goals. Superannuation rules will always evolve, but clarity creates confidence. If you are unsure how these changes might affect you, your business, or your family's future, that's exactly what CBEX Financial Solutions are here for. Reach out, start the conversation, and let's make sure your super strategy still supports the life you're chasing. Until next time, keep chasing the dream. Thanks for listening. I'm Chris Bex, and I look forward to presenting our next episode to you real soon.
If you enjoyed this episode and you'd like to help support the Chasers channel, we would love you to share it with your business friends and colleagues, post about it on social media, or leave a rating and review. To catch all the latest from CBEX Business Solutions for Good, follow us on Facebook at facebook.com/CBEX, Instagram at CBEX, and on the internet at cbex.com. Thanks again, and we'll be sharing new info with you on our next episode.